Assalamualaikum and good morning. Today, our group will talk about small and medium enterprise, also known as SMEs. SMEs represent the majority of business establishment in Asian countries. They played a very important role in the economy because they provide job opportunities and support economic growth. However, during the COVID-19 pandemic, the situation became worse for many SMEs. The pandemic reduced sales and increased business risks, which made it harder for SMEs to survive. Because of this, it is important to understand the challenges faced by SMEs and the financial solution that can help them.
Okay, my name is Aina Patricia and I'm going to continue this presentation with the first content. Okay, so first, in this article, it's talk about critical analysis and discussion. The reason is bank sees SME as risky borrower. It is because their income is unstable and financial records are limited, making loan repayment uncertain. Next, because credit guarantee schemes. Credit guarantee schemes reduce bank risk by sharing possible losses with the government, which encourage more SME lending. In addition, loan default rate. The study finds that the loan default rate is the main factor in deciding how much guarantee is needed. Next is not fair and can cause problem. By applying the same guarantee level to all banks is ineffective because banks differ in strength risk and it may lead to moral hazard. During COVID-19, SME need higher government support to survive. It is because SMEs were more vulnerable, so higher government guarantees were necessary to help them survive the crisis.
Hi, I'm Ima Shakira. So I will present the content of number 2, which is the originality, logical, and reasonable. So for the first point, uses PCA and cluster analysis to group bank based on their financial strength and risk level. This is a novel approach because it does not treat all the banks the same and allow more accurate policy decision. So the second is, it also applies VAR and impulse response analysis to clearly show how shock from COVID-19 affect SME financing and bank behavior over time. So the last one, the paper has a strong logical flow, which is starting with economic theory, followed by the data analysis, then empirical result, and finally policy recommendation. Because each step builds on the previous one, the conclusion are reasonable and well supported by evidence.
And lastly, importance of SMEs in Asia. Small and medium enterprises play a crucial role in Asian economics because SMEs contribute approximately 23% to 58% of gross domestic product and account for between 51% and 97% of the total employment across the Asian member states. This figure highlights the importance of SMEs as a key driver of economic activity and job creation in the region. Furthermore, SMEs support inclusive economic development by providing employment opportunity and income generation, particularly for lower and middle income groups. Therefore, disruption to SME operations, such as those caused by the COVID-19 pandemic, have significant implications for overall economic stability and growth in Asia.
My name is Muhammad Fizan Ashton bin Faiz. I will present for the conclusion part. For the conclusion, first is guarantee level should be different for each country and bank. This means not all banks face the same risk. Strong bank can handle higher guarantee, while weaker bank need lower ones. Also, each country economy is different, so one policy cannot fit everyone. Second is government should give more support during crisis and reduce it later. During crisis like COVID-19, SME struggle the most. Higher guarantee help bank continue lending. When the economy improve, support should be slowly reduced to avoid over-dependence. The point is, better guarantee system help SME recover and grow after COVID-19. Well-designed guarantee scheme make it easier for SME to get loans. This help them survive the crisis, reopen the business, create jobs, and grow in the long run. That's all from us. Thank you. For the next slide is relevant cash flow. Relevant cash flow refer to the money coming in and going out that is directly related to a project. For the benefit, improve access to financing, business continuity, and smooth operation. For the cost is loan repayment obligation, operating expense, which is salary, rent, utility. For the technique used is payback period. For measure how long it takes to recover the initial investment. A shorter payback period means lower risk. Second is net present value, NPV. For calculate the actual value of future cash flow today. A positive NPV indicates the project is worthwhile. For the investment appraisal, is the process of evaluating whether a project should be accepted or rejected. Compare project benefit and cost, help management make better decision. Very important for SME with limited financial resources.
Okay, so for next, we will present about the case study. And for the question A, we have initial outlay, annual differential cash flow, and terminal cash flow. So I will start with initial outlay. So how to calculate the initial outlay? The purchase price 520,000 plus installation 60,000, and we'll get depreciable value 580,000. So we need to plus additional working capital, which is 600, and we'll get 640,000 for the total cash outflow. And then we minus with cash inflow, which is sale proceed 120,000, and tax loss 200,000. So where did we got the tax loss? Okay, we can look for the working one, which is we'll start with depreciation. Looking for depreciation, cost minus salvage value, and divide useful life. 400,000 minus 25,000 divide into 8 years. So we get 46,875,000. And disposal, cost minus accumulated depreciation, 400,000 minus 46,875,000 times 4, and we'll get 212,500,000. And where did we know the tax loss or gain? Selling price minus net book value, which is 120,000 minus 212 and 500,000, and we'll get 92,500,000, but we need to plus 24% to get 22,200,000, but it will be negative.
So as we can see here, we have working to depreciation, but I'm going to go through the annual differential cash flow down there first. We have sales revenue amount 220,000 ringgit, and we add with reduced in wages 25,000 ringgit. Then we will get the total cash inflow 245,000 ringgit. And then we have to less with increase in maintenance 10,000 ringgit, less increase in rent storage 35,000 ringgit, less increase in depreciation 61,125 ringgit. So and then we can get net income before tax amount 138,875 ringgit. So how we get the depreciation is the old machine cost minus salvage value divide with useful life. So for the old machine, the cost is 400,000 ringgit less 25,000 ringgit divide with 8 years, and we will get 46,875 ringgit. For the new machine, we have the cost 580,000 less 40,000 ringgit divide with 5 years, we will get 108,000 ringgit. As we can see, the new machine depreciation is higher than the old machine. So the depreciation is 61,125 ringgit. Then we less with tax amount 33,330 ringgit. So how we get the tax is 138,875 we times with 24%. Then we will get the net income after tax. The net income after tax is 105,545 ringgit. And we plus with depreciation 61,125 ringgit, and we will get the differential cash flow amount 166,670 ringgit. Okay, next I'm going to present about terminal cash flow. So for terminal cash flow, we have salvage value amount 40,000 ringgit, and also we have to add with working capital, and our working capital is 60,000 ringgit. So that we will get 100,000 ringgit for the terminal cash flow.
Next, the payback period is calculated to determine how long it takes for the project to recover its initial investment. The payback period is calculated by dividing the initial outlay of 497,800 ringgit by the annual cash flow of 166,670 ringgit. Based on this calculation, the payback period is approximately 2.99 years. This means the project is able to recover its initial investment in less than 3 years, indicating a relatively short payback period. Lastly, the net present value of the project is calculated using a discount rate of 10%. In year 1, the initial investment of 497,800 ringgit is treated as a cash outflow. For years 1 to 5, the annual net cash flow of 166,670 ringgit is discounted using the present value interest factor of annuity at 10%, which result in a present value of 631,812 ringgit and 64 cents. In year 5, the terminal cash flow of 100,000 ringgit is discounted using the present value factor of 0.6209, giving a present value of 62,090 ringgit. After summing all the present value and subtracting the initial investment, the project net present value is 196,102 and 64 cents. Since the NPV is positive, this indicates the project is financially viable and should be accepted.
Okay, next I will explain the internal rate of return or IRR. IRR is the discount rate that makes the net present value equals to 0. It helps us decide whether the investment is acceptable or not. First, we'll calculate the positive net present value using a discount rate of 12%. At 12%, the total present value of the cash inflows is 159,752 ringgit 2 cents, which means the NPV is positive. Next, we calculate the negative net present value using a higher discount rate of 24%. At 24%, the NPV becomes negative at 6,114 ringgit 18 cents. Since the IRR lies between 12% and 24%, we use the IRR interpolation formula. Using the formula, we add the lower rate, which is 12%, to the proportions of the positive NPV over the totals of positive and negative NPV, multiplied by the difference between the two rates. After calculation, the IRR is 24.48%.
Lastly, we are using the internal rate of return to help make a decision on whether the company should replace the old machine with the new one. Based on our calculation, the net present value is positive, which means the project is expected to generate more value than its cost. Next, the payback period is less than 5 years, so the company can recover its initial investment in a relatively short time. Moreover, the internal rate of return is 24.48%, which is higher than the company cost of capital of 10%. This shows that the return from the project is acceptable. Therefore, we can conclude the company should replace the new machine as all three methods, the NPV, payback period, and IRR, to support this decision. That's all from us. Thank you.